Let's get your market opinion, an important one at that. Anand Shah, Deputy CEO and CIO of BNP Paribas Mutual Fund, joins in with his views on how he's sizing up the market at current levels. It's great to have you on the show, Anand. Thanks very much for taking out the time. Now, you're saying correction is inevitable post the 13-month rise. So does that mean that as a fund manager and his CIO, you're cautious and perhaps are looking at increasing cash levels in the market right now, or do you stay put in the investments made?
Hi, very good morning. To me, this entire correction I see was a much needed correction. I think, as you rightly said, 13 months of unprecedented rally, and everybody was waiting for correction, and that's part and parcel of the market. So we're not really too perturbed with the current correction. It's part of the cycle with which it goes through. We believe this will sustain and continue another 15-20 days into April as well, till we actually start getting some results. Because if you see from a fundamental point of view, I think what the markets has been waiting for last few years has been a robust earnings growth rate, and our channel checks and our data analysis on all the micro levels on monthly sales, we are seeing quite a recovery on the economy from the base of demon and GST. So earnings is something which would continue to support the markets as we enter the April second half. In terms of how I see markets, I think we continue to remain quite optimistic, and to that extent, we're not taking too much of a cash calls. Having said that, our view is more stock specific. We believe in the rest of the calendar year, or in the financial year 19, it will be a very interesting year for stock pickers, given the macro will remain challenged. So that's something which people will have to keep in mind.
Thinking about individual stocks, Anand, today clearly seems to be belonging to autos. We've seen some great reportage in the monthly sales for the month gone by, and now you're seeing some of the auto ancillaries as well as tire names as well holding out quite smartly. Add to that, this seems a global trend, because you've seen the North America Class 8 truck orders as well come in extremely robust. How is it that you classify within autos on what to buy afresh and what to keep on holding?
So, as far as India is concerned, very clearly we are seeing recovery, which is quite broad-based and beyond auto, also on the back of government spending. Very clearly, from farm loan waivers in the previous calendar year till increase in MSPs or increase in support to the farm income. All along, we are seeing quite a robust spending by government, leading to quite a recovery, especially in the rural spending, is what we are envisaging in this coming financial year. And to that extent, that's reflecting in some bump up in the auto sales numbers already, but will sustain through the financial year. So from the domestic point of view, I think we are more inclined towards passenger vehicles, and that too, having exposure to rural India, which will fairly outsmart or will outperform the overall auto segments of the market. Having said that, on the international side also, there has been a global recovery which is expected. There's a lot of noise around inflation to keep looking up globally, and frankly, the positive side of that inflation is actually the growth picking up. So yes, even in the US market, we are seeing some pickup in consumption and auto sales, but from India perspective, we are very clearly seeing uptick in the rural spending, and farm income being the focus area for the government in coming 2 years. We are expecting more outperformance from the passenger vehicles exposed to the rural India.
Okay, Anand, this has been our question to most fund managers right from the start of trade today. Just getting as much opinion as possible on how mutual fund managers or CIOs such as yourself are approaching the banking sector, because that's a class overweight sector in most MF portfolios. And a lot of them, especially some of the large cap funds, do have exposure to ICICI Bank and Axis Bank. I know from the PSU banks, the call is really, or the investment position is really in SBI or a Bank of Baroda for that matter. Select few, but given the exposure that you may have to the private banking space, and in specific to these two tainted names right now, or controversy marred names, what's the approach that you would take to the banking space? What is it that you would tell your unit holders, to your investors tuning in right now?
I think indeed, yes, we do have an overweight position, but we largely focus towards the B2C space of the market. So if you see, a large section of our banking exposure is dealing with banks, dealing with the retail households. That's what is a dominant part of our portfolio. We continue to maintain that the corporate stress on the portfolios is towards coming to an end. I think we have seen a lot of NPA recognition which has already happened, and with the NCLT various resolutions that are coming through are also actually quite positive. And to that extent, I think that will also bottom out in this next 12 months for quarters, where the news flows around the NPAs on the corporate banks is something which will start getting little better as even the cyclical recovery will also come through. So I think we've been all along quite overweight on the banks which are more household oriented, because the NPAs have been quite low. The competition, the lending side, notwithstanding some competition from NBFC, was also quite benign, so the margins were quite good, and obviously there was not much of an NPA issue. So now what we are saying is, slowly and gradually we would like to actually increase some exposure to the corporate banks also, as we see more and more things unfold, more NPAs get unfold, and that is when we will see these stocks would also sort of bottom out and will give an opportunity to enter at a right price in this stressed banks also, which have large corporate exposure.
Okay, and then just an extension to that question now, what is the approach that you're taking to some of the financing companies as well? I know they are not completely under the purview of, or rather completely under the purview of, essentially being reviewed on account of the bad loan mess that banks are facing. But a lot of financing companies, I would believe, their books will also come under scrutiny sooner rather than later. So what is the investment rationale and approach there?
If you are asking on financing companies, means the NBFCs, I think we've been sort of quite cautious on NBFCs given the rising interest rate environment. Very clearly, as the interest rate bottomed out 9 months back, we had started unwinding our exposure to NBFCs because their cost of funds will actually grow up much faster than their ability to pass on to the customers. To that extent, we've been quite underweight on NBFCs on our portfolios. We see, one, the valuation was quite high. At the other end, even the profits will be stressed because of the lower margins as we enter into a higher interest rate environment.
Okay, Anand, we'll leave it at that. Great speaking with you. Thanks so much for highlighting what you're feeling about the market and the avenues of opportunity in this current market downturn.